Hello, Assalamu alaikum students. This is your teacher again with one more new video, and this time we are going to solve again the latest paper. And this paper is basically, as you can see, that this is um, your paper 2 accounting, and May June 2023. This is your latest paper. Okay, and you have 1 hour 45 minutes to complete this paper. And as you can see that this is gradient 2, which I'm going to solve right now. Okay, so first of all, we have question number 1, in which the examiner is asking you to make a cash book and just try to understand the concept of this question. Okay, so in this question is basically Umar is a trader. Okay, so the following transaction took place in April 2023. So this is our closing year. April 3, this is a transaction which occurred in between the April. So April 3 paid $1,000 into the bank from his own personal money. Okay. And April 7, I think we should make the cash book while reading the person. Okay. So there is basically balance BD and um, balance BD 120 for 1st April and balance BD in bank, which is $477. It is already this is your written balance in your cash book. So that's why we will start to solve our question from the April 3. Okay. So first of all, in the transaction of April 3, we are saying that paid $1,000 into the bank from his own personal money. So we know that whenever an owner is investing or using his personal money into the business, so we say that it is basically increasing the capital. Why? Because this is the new money, or you can say the fresh investment coming from outside. Outside basically from the owner. So that is why whenever any owner is using his own personal money into the business, like um, whenever he is taking out some money or vehicle or any other thing, taking out from his personal things, personal possessions, and using those things into the business for the as an investment. So we say that it is basically increasing the bank balance. Okay, it is increasing the bank. So here the bank is increasing and capital is also increasing. So the nature of capital is credit and the nature of bank is, because this is our asset, and the nature of asset is debit. So that's why we will record this entry on the debit side of cash book. So we say Apple tree capital, it's increasing by 1,000. It is basically he invested his money in he just basically he transferred that $1,000 into the business bank account. So that's the reason that we will add $1,000. We will record $1,000 on the debit side in the bank column. Okay. So we have one another transaction for April 7th. Paid $360 to a supplier, Alexander, by telephone transfer. So basically, Alexander is our supplier, and we paid $360 to him. So whenever any expenses is occurring, so it will decrease our cash. So that's the reason that we will record this transaction on the credit side. It is basically your cash expense, and you paid this expense to the Alexander. So your cash would be, your bank would be credit, and your supplier will be debit, because supplier is decreasing. So that's the reason that supplier, we will use the reference of supplier on the credit side of cash book, and our bank is decreasing by $360 because we have paid $360 to the Alexander. So that's why we are recording this transaction on the credit side. Okay. So after that, we have another transaction on 10 April. Cash sales $695 were paid directly into the bank account. So if there is any kind of cash sales happening, so we will record this on the debit side because it is increasing our cash. So we will use the date. It happened on 10 April, and this is basically sales. Okay, so sales was for 695. Okay, so after that we have one more transaction on 12 April. So on 12 April, we purchased goods $340 on credit from the Alexander. Okay, so we purchased the goods on credit. Okay, so basically we purchased the goods on credit. So it means that we didn't pay anything yet. If we didn't pay anything, so it means that we will not record this entry into the cash book, because all the transactions which is occurring in the business in the form of cash or bank or check or anything, so we will only include those type of transaction in our cash book. Okay, because cash book is a prime book basically. Okay, so after that, on 15 April, paid $68 cash for petrol. So of course, if we paid $68 for gas, so it means that we have to decrease this amount. It happened on 15 April. It is like motor expense. And we paid in the form of cash. So that is why we will deduct 60, we will carry $68 in the cash column. Okay. So after that, we have annual transaction. On 16 April, paid rent $400 by standing order. So what is standing order means? Standing order means that this is the same transaction which usually deduct from our bank on monthly basis. So that is why we will deduct $400 from the bank. Okay. And the next transaction is on 23rd April. Received a check $384 from a current customer. Esme in full settlement of an invoice of $400. Okay. So we received a check from the SMA and we received a check which is for the $384 and in full settlement of an invoice of 400. So it means that we supposed to receive from her the $400. It means that we gave her the invoice of $400 and we received $384 from her. So it means that the amount which is we are right now receiving, so we will record only this amount because we are receiving only this amount in the form of check. So that's why we will record only $384 on the debit side because we are receiving this thing. So that is why it happened on the 23rd April. Estimate 380, 386. And because this is kind of full settlement, it means that she's supposed to pay us $400, but she paid $386 as full settlement. So it means that somewhere we might give him her a cash discount. So just find a difference between 400 and 386. So we have $16 difference basically. So this is our cash discount. And we always record the discount allowed on the debit side because this is kind of expense for us. Okay. On 27 April, paid 323 by check to Alexander having deducted $17 cash discount. So we will record this is basically a cash discount received. So we will credit the $17. Why? Because um, discount received is basically our income and the nature of income is credit. So whenever income is increasing, so we will credit the transaction, the amount. So that's why we will say that on 27 April, we paid Alexander $323 and we received $17 as cash discount. Okay. So after that, we have one more last transaction. 28 April, on 28 April, purchase goods to $235 on credit from the Alexander. So we purchase the goods from the Alexander on credit. So again, this is our credit transaction. So we will not record this transaction in the cash book because all type of transaction, whether it is expenses or income, but it should be in the form of check and cash. So we will record only that type of transaction in our cash book. But this is a credit transaction, so we will not record this transaction into the cash book. Okay, so now we are going to add the amounts. Okay, so let's add the credit side first. $477, 360, 400, and 323. So basically, our debit side is heavier. $1,695 and 384. So we will have 2079, 120 as it is. and $16 averages. Okay, so we have to balance this here. Okay, so when we deduct 477, 360, 400, 323 from 2079, so we have 519. And when we deduct 68 from the 120, so we have 52 as our balance CD on 30 April. So we have this amount on the debit side on 1st May 2023. Okay, so let's move forward to the next question. So we have next question in which the examiner is asking they prepare the account for Alexander for April 2023, balance the account and break down the balance at 1st May 2023. So basically Alexander was our supplier. So we have to maintain the Alexander account also. So here you can see that the balance BD is for your supplier is $360, and we have to record the other transactions. Okay. So Umar buys all his supplies from Alexander, who does not allow Umar any trade discount. Umar is now considering also purchasing supplies from Tahir, who would offer him 3% trade discount, but no cash discount. Okay. So we know that Alexander gave Umar the cash discount, but she is not giving him the trade discount. So that is why Umar is now thinking that he should change the supplier. So first of all, we have to make the Alexander account. So we will use the same entries which we just leave in the cash book, which shows our current entries. So we have basically this current entry, okay, and this current entry. Yes. We didn't record this transaction in the cash book. So we will now use this transaction. So we purchases goods $340 from the Alexander, and on 20 April we purchased goods from the Alexander on the credit term for $235. So we will record these transaction on the credit side because of this our supplier is increasing. So that is why we will record this transaction on the credit side. So on 12 April, purchases happen for $340. And on 28 April, we again purchased goods from the Alexander on the credit basis for $235. So we also paid or some amount. So whenever we are paying the amount to the supplier, so it means that it will decrease our supplier. So whenever a supplier is decreasing, if Alexander is basically our supplier. So if any transaction happens because of this, if supplier is increasing, so we will make the credit entry. And if supplier, or we can say the creditor, is decreasing, so we will make the debit entry. Okay. So whenever we are paying the money to the supplier, so it means that our supplier is decreasing. So that is why we say that we will record that type of transaction on the debit side. Okay. Okay, so as you can see that on 7 April, on 7 April, we paid $360 to the Alexander. Okay. And we also paid the, I think I just forgot to write the 27 April transaction. Okay, so we paid $323 check to the Alexander. Okay, so it means that we have paid 2 times to the Alexander. So that is why we will record these transaction on the debit side because our supplier Alexander is decreasing. So we have paid him by the check. So we will write the bank because bank is decreasing. And on 27 April, we have paid him $323 check. And we also received discount. So we always record the cash discount, but not trade discount. So we have balance CD on the debit side, 235, and it will transfer on the credit side for the next month, which is my one. It means that still we have to pay $235 to Alexander. Okay, so is part C, in which we are going to advise that Umar whether should choose option 1 or option 2. Okay, so we have option 1 and option 2. So in option 1, purchase supplies from Alexander only, or option 2, purchase supplies from both Alexander and Tahir. So if we purchase supplies from the Alexander, so we will get only cash discount. And if we use option 2, so we will get the trade discount and also the cash discount from the Alexander. To justify your answer by providing three advantages and one disadvantage of the option you have chosen. Okay. So, first of all, let's discuss the advantages. Basically, here we know that in option 1 and option 2, we see that there are advantage if we go with the option A. So, what type of benefits we will see in the future? So, first of all, on option A, Alexander is giving us offers cash discount. Okay, this is the number one advantage. But Tahir is not giving any cash discount. Okay, so and one thing is that basically, as we can see, that we are receiving $17 discount from the Alexander. So it means that if we try to calculate it, so we are receiving the 5% discount from Alexander. This is also a positive thing. Okay. And if you see that Tahir is only offering 3% rate discount. So this is a good thing that Alexander is giving you 5% discount and Tahir is giving you only 3% discount. This is also a disadvantage, or you can say the advantage basically of option 1. Okay, and one thing that we are already purchasing the supplies from the Alexander, so it means that Alexander is reliable. Okay, and after that, let's talk about a disadvantage. So in option 1, we have to describe the one disadvantage. So there is basically the disadvantage is that in option A, Alexander is not giving us any trade discount. This is, you can say, the one disadvantage, and the other disadvantage is that if we go with the option A, so we have to depend on the one supplier. Okay, and I think this is enough disadvantage we have written here. So if we talk about the option 2, so advantages are there. This is the Tahir is offered trading discount. This is one advantage. Okay, and it means that cost of goods will reduce if we go with the option 2, because at the same time we are receiving the cash discount and the trade discount from both suppliers, so it means that our cost of goods will decrease. So this is the second advantage. And if we talk about the disadvantage, so disadvantage is that Alexander is offering cash discount, but T is not. Tahir. This is the number one advantage. And basically, Tahir trade discount is lower than the Alexander's cash discount, and it has also damaged the relationship with the. So we have done with our part. So whatever you want, if you want to go with the option one or option two, this is totally your choice. Okay. So after that, we have question number two. So in question number two, Ramla has calculated her draft profit. So it means that there are some changes which we have to record, because this is your draft profit. It is not your final and accurate profit. So Ramla has calculated her draft profit figure for the year ended 28 Feb 2023. Adjustments in Ramla's ledger accounts have still to be made for the following items. Okay, so let's read the adjustments. So there is a first, um, uh, like we have basically five adjustments, and in the part A, uh, the examiner is asking to prepare the journal entries. So we will make the journal entries and while reading the transactions. Okay, so in first um, adjustment, an amount of $99 owed to Ramla by my is to be written off as irrecoverable. So if it is irrecoverable, it means that Ramla is basically the owner and my is basically your debtor, because $99 owed to Ramla by my is to be written off as irrecoverable. So it means that this is our bad debt. So what type of inventory we have to, what type of entry we have to make for this transaction? So irrecoverable debts would be debited. Would be debited by $99 and my would be credited. Okay. So basically we are decreasing our customer, so that's why we are crediting it. And we know that irrecoverable debt is our expenses, so that is why we are recording it on the debit side. So after that, in number two, fixtures and fittings, $875 were purchased or carried from the Padma. So this is very easy, that we purchase a fixture and fitting, so this is our asset. So it would be debited by the same amount, which is 875. So in number two, fixtures and fittings would and Padma would credited, because we purchased fixture and fittings from her on the credit basis. So it would be credited. Padma would be credited. Okay, so after that we have number three, a loan repayment $500 had been incorrectly recorded as loan interest. So basically, we paid the loan, but we recorded it as loan interest. So what we have to do is basically loan interest. We will credit the loan interest because we mistakenly add this 500 into the expenses. So that's the reason that we have to decrease the expense. So we will credit the loan interest. Okay. So what entry we have to make is loan repayment would be debit and loan interest would be credit. Okay, so after that we have number 4 adjustment. Rent paid $350 had been recorded as 530. So we should record the rent 350, but we accidentally recorded 530. It means that we overstated this 350 minus 530. We paid 350 rent, but we record 530. So it means that we overstayed this amount. We overstayed the rent payment. So first of all, try to find out the difference, which is 180, 530 minus 350. And so we will reduce the rent payment by 180 because we accidentally overstayed the rent payment. So what entry we will make is, because we want to decrease the rent and we accidentally made the entry for 530, it means that we are maybe you can say that understating our bank or cash statement, bank or cash. So now we will debit our bank and cash because we mistakenly um, over credit our bank and cash. So that is why we have to make the debit entry for this. We are now increasing our bank and cash, and our rent was 360, but we recorded 530, I think. So that's the reason that we have to decrease the rent payment. So that is why we are crediting the rent by 180. Okay, so drawings $120 had been debited to the wages account. So it means that we mistakenly increased our wages account by 120, but it should not. We should not have done like this. That means that now we have to credit the wages because if we want to increase the wages, so we will debit the wages because it is our expense. But here in this case, we accidentally mistakenly recorded some extra amount in the wages account. So it means that we have to credit the wages because we want to um, decrease the wages. So it is basically 120. So drawings would be debited. We are increasing our drawings and we are decreasing our wages. Okay, so we have done with this thing. So after that, we have next part. In B part, complete the following table by entering the amount of each adjustment required to calculate Ramla's adjusted profit. If an item has no effect on profit, enter 0 in the no effect on the profit box. So this is our draft profit. Okay. So the above adjustments we just made the entries for it. So now we are going to record these entries into this, and now we are analyzing that which type of entry will increase our profit and which type of entry will decrease our profit. So it means that at the end we will find our accurate profit. Okay, so in entry 1, we are debiting our bad debts. So it means that our bad debts increased. So if our bad debts increase, so first of all, what type of entries will make negative influence or positive influence on the profit? So we know that whenever we are trying to make the income statement, so first of all, we have revenue, and after that, we have cost of goods sold, and after that, we have GP, and after that, we have expenses, and then we have profit. So if revenue increasing, so it means that our profit is increasing. If cost of goods sold is increasing, so it means that our profit is decreasing. If expenses are increasing, so it means that our profit are decreasing. So we will apply this concept on these entries. So we know that irrecoverable debt is our expense. So if expense is increasing by $99, so what will happen? It will decrease our profit. So we will record this. So our error one will decrease our profit by $99. Okay. Okay. So next in two, fixture and fittings and Padma. So basically we have purchased fixture and fittings from the Padma. So fixture and fittings are asset. So we know that an asset is basically we will record the assets in the balance sheet, statement of financial position. Statement on of financial position. So it means that this is not the part of the income statement. If we are purchasing the fixture and fittings, so what will happen? It will have no effect on the profit because this is our asset. So and Padma is our trade payables, and we know that trade payables basically record in the statement of financial position. So basically these transactions is for statement of financial position. So there is no effect on the profit. So it has zero effect. And in adjustment 3, loan and loan interest. Okay. So we accidentally basically we repay the loan, which is $500. A loan repayment $500 had been incorrectly recorded as loan interest. So we know that loan interest is our expense. So if we mistakenly add this $500 into the expense of loan interest, so it means that we overstate our expenses and we understated our profit. So now we are basically made the journal entry. We just made some corrections into it. So we credit our expense of loan interest by $500. So it means that if our expenses is decreasing because we just made the right entry for it. So it means that it is also increasing our profit now because this was the draft profit. So that is why whenever we are rectifying our errors, so it means that it will create a positive effect on the profit because previously we just deducted the $500 from our profits as an expense, but now we are adding back $500 into the profit because we just rectify our mistake, our entry. So it will increase the profit by $500. Okay, so in in number 4 item, there is basically rent is decreasing. We accidentally, mistakenly, we paid $350 as rent had been recorded as 530. So it means that we increase the amount by 180. We increase our expenses because rent is our expenses. So we increase our expenses by 180. So it means that were causing a reduction in the profit. So now we are correcting this error. So that's why what is happening here, we are adding back 180 into the profit, because previously we deducted 180 from the profit mistakenly. So now it is increasing our profit. Okay, so after that, in journal entry number 5, drawings of $120 accidentally. We accidentally record the drawings for which is basically for $120 had been debited to the wages account. So it means that again mistakenly wages account is our expense. We mistakenly add $120 as expense. So it means that previously we decreased our profit. But now because we are rectifying this error, so it means that now this $120 will be add back into the profit. So the amount which will increase in the profit would 800, decrease is 99, effect is 0. So we will add 800 into the 11650 and deduct 99 from it. So we have 12, 3, 5, 1 as our adjusted profit. Okay, so I think we have last question. Okay, so in part C, explain how the general entry of item 1 complies with the prudence principle. So basically, item 1 was about the bad debts or irrecoverable debts. So prudence basically state that prudence basically state that profit and assets are not overstated. It should not overstated, and losses should not overstated, and losses and liabilities are not understated. So because irrecoverable debt should be written off to ensure their profit, so that is why it is compliance with the prudence principle. And after that, we have the question part 2, how the general of 5, item 5 complies with the business entity principle. So item 5 was about the drawing. So a business entity is basically that the owner has a separate entity, separate identity, and the business is basically has a separate legal identity. So it means that whenever owner is investing money from his own bank into the business, so it means that we will credit the business, we will credit the business and debit the bank balance of the business. And whenever an owner is extracting some goods and some cash from the business for his personal use, so we have to maintain account for drawing and we will deduct the drawing from the capital. So it means that business has its own legal identity. So it means that we cannot use the money and resources of the business as per uh, our needs. So it means that business has its own legal identity. So this is basically drawing concept is totally complies with the business entity. So I'm not going to write it here. So this is all for today. So we have some other questions right now, but in this video, I will stick on 2 questions. So I will make another part of this video and we will try to solve the other questions which is remaining right now. So, and if you have your accounting paper as if you have your accounting paper in upcoming days, so you can contact me in the comment sections. And if you have any curiosity to this video, so you can ask me also. And one more thing I want to tell you that my online classes available right now. So if you want to take classes from me, basically I'm giving the classes for O-levels and A-levels accounting and business. So you should watch my other videos also. which is basically business studies and accounting for the other classes. And admission is going right now, and for my June 2024 session. So if you're willing to get my classes, so you can DM me on WhatsApp or Facebook, or if you don't have any access to my social media platforms, so you can comment under the comment section and I will reply. Okay, so Allah Hafiz.